is Group 1, which includes Alex, Eunice, myself, and Syafiq. So we are doing analysis of the financial performance for Huatai Industries Berhad for the year 2011 until 2020. So a little bit of introduction. Huatai Industries is one of Malaysia's premier and earliest biscuit manufacturers. It produces a wide range of biscuits and has was established in 1962. So Huatai's vision is to be the leading biscuit and confectionery manufacturer in the region for its product quality and variety. So it has actually successfully established a strong presence in Malaysia, as well as it has successfully built up wide international market in more than 50 countries all around the world. So moving on to the profitability ratio, we can see that over the last 10 years, um, it has been a little bit unstable, especially in the earlier years, whereby the net profit margin was negative, as well as the operating profit margin, as well as the rate of return. It took the deepest dip in 2018 and 2019, but we see a very positive comeback in the year 2020, with an increase in the net profit margin, gross profit margin, operating profit margin, sales return, rate of return of ratios, as well as asset turnover ratio. So a little look into the specific ratios. So the net profit margin reached a record high in 2020. So this positive growth could be attributed to the improvement in management of resources, therefore increasing their revenue for the year 2020. For the gross profit margin, it has also shown that it was stable over the last 10 years, but it reached its highest in 2020. So this could also be due to the fact that their revenue has also increased, but they were able to maintain the cost of sales, achieving better economic scale. So the operating profit margin basically is a ratio to indicate how much profit the company makes. So in 2020 also it has improved drastically. So this could be due to the lower administrative costs as well as expenses. Overall, the rate of return also was best in 2020. So they in the last 10 years they were not really utilizing their assets efficiently, but improvement was seen in 2020. So the asset turnover ratio as well, the positive improvement in 2020 shows that the company was more efficient in generating sales as well as revenue from its asset base and the assets such as plant equipment, and they were fully utilizing it better in the year 2020 as compared to previous years. Okay, I pass it to Dr. Alex.
Hi. So this is the liquidity ratio. So the one that we calculated for the past 10 years for this Huatai company. So we can see that for the initial years from 2011 to can we go back for a while? Hello? Yeah, so for the working capital, during the initial years of business for this company, so the working capital remains in deficit actually until year 2015, where can we go back to the next slide? Uh, Next, where until year 2015, it actually turned positive until 2020. So sorry, the previous slides. Eunice, I cannot. Yeah, okay. Then next is the current ratio. Since 2015 until the current year, the company is able to maintain the current ratio of more than 1, which means that the company has got adequate current assets to pay off their short-term debt. And for the cash ratio, the cash ratio for this company throughout 10 years is always less than 1, which means that the company is not liquid in terms of cash ratio. The amount of cash and cash equivalent is far less than the current liabilities. The company has got insufficient cash in hand to pay off the short-term debt. And for acid test ratio, during the initial years, the acid test ratio is below 1, which means that the company do not have enough liquid assets to pay their current liabilities. However, since 2015 until 2019, the company is able to achieve acid test ratio of at least 1 until the current year where the ratio drops to 0.81. Throughout the 10 years, acid test ratio is lower by around 20% compared to current ratio, which means that the liquidity relies moderately on the inventory. The next, this is the table that we have made out for efficiency ratios, which consists of ROE, ROA, inventory turnover ratio, day sales in inventory, accounts receivable turnover ratio, day sales in receivables. So for the efficiency ratio, return on equity, the return on equity of this company over 10 years shows that it does not perform well in generating profit and it's not a profitable company. Half of the time, the company is losing money with a negative ROE, while the highest profitable ROE is only at 3%. For the return on asset, in terms of return on asset, the company doesn't seem to be profiting a lot in relation to its total asset. The company is not efficient in using its asset to generate income. Similar to ROE, the company's ROA is negative half of the time, which can be concluded that the company is not efficient in using its resources and assets to generate profit. The inventory turnover ratio overall it is low. So the ratio ranges from 5.32 to highest in 2013, which is 9.72. This turnover ratio is considered low for a food manufacturing company. As we noticed, the ratio is higher during the initial years, which is above 9, and throughout the recent year, it it hovers around 5.3 to 5.8. The company is either weak with their sales or are holding too much inventories in hand. Then for the day sales in inventory increases over the years from 38 to more than 60 days. So it simply means that the company is taking more days to clear off their inventories. This clearly states that the sales of the company is not doing well and need longer time to sell off their products. There is less demand for their products. And for account receivable turnover ratio, the company has got low account receivable turnover ratio, which is around 2.64 to 3.37 throughout the 10 years. The company's collection of accounts receivable is not efficient, bad credit policies, and should improve its collection process. And lastly, for day sales in receivables, the company has high day sales in receivables, which is around 120 to 130 days. Basically, the company is selling its product to customers on credit and waited a long time to collect the money. The company should plan a better collection process to shorten the day sales in receivable ratio in order to collect the money from customer faster so they can have better cash flow in hand. Next, I'll pass on to the next one.
Okay, so I'll be talking about the solvency ratio. So basically, solvency ratios are used as a metric to assess the company's financial health to see if the company is able to meet its long-term debt obligations. So the first ratio that we'll look at is actually the debt ratio. So generally, if the debt ratio is less than 1, the company has more assets than debt. So we can see here throughout that Huata is actually maintaining its debt ratio between 0.54 to 0.74. So they are at a lower financial risk relatively as they're still able to pay off their debt. So the next one is the debt to equity ratio, which measures how a company finances its operation through debt and versus owned funds. And so it should not be more than 2. So from this, we can see that initially, from 2011 to 2014, that their debt to equity ratio was more than 2. So initially, they could have been using debt to fund their expansion projects, and then subsequently may have been able to slowly pay it off from 2015 onwards. Then the last solvency ratio that we have is the times interest earned ratio, the TIE ratio. So this assesses how a company is able to meet its debt obligations based on the current income. So as you can see, the last row, the ones that are highlighted in red are all a negative. So it will be the years of 2011, 2014, 2018, and 2019. So during this time, actually, the company was having net losses. So they could have, this implies that the company could have been facing some financial troubles and was unable to pay off its debts, similarly to what my group mates found earlier. So, but then in 2020, their revenue increased and therefore Huatai was able to reduce its debt, and then it was able to meet its total interest payment by 2.15 times over. So next we have the market valuation ratio. The market valuation ratio is actually used to evaluate the current share prices of the public listed company stock to determine whether the investor is paying more or under for its value. So the first one is the earnings per share, which indicates how much money a company makes for each share. So basically, a higher EPS will indicate a greater value. So investors are actually willing to pay more for the company shares if they believe that the company has higher profits relative to its share price. So similarly to the TIE ratio, because Huatai was having net losses in those 5 years, therefore the EPS was actually negative, actually ranging from a negative 1.44 all the way down to negative 6.09. So Hawata is actually slowly able to increase its revenue by almost 10 million from 2019 to 2020, and therefore they were able to bring their EPS from a negative 2.97 to 1.46. And then the last ratio for market valuation that we have, which is the price per earning ratio. So this one will measure the current share price relative to its EPS. So investors will use this to determine the relative value of a company's shares either against its own historical records or against other companies in the same market. So the PE ratio is relatively low for Huatai because it ranges actually between 0.26 to 0.94. And then established companies actually may experience periods of negative cash flow due to multiple factors, causing a negative PE ratio. So, and then having net losses also contributes to it. So in 2020, actually, with a PE ratio of 0.28, that actually means that investors were willing to pay 28 cents actually for getting $1 of the current earnings. So they could think that that with the low stock price that they are buying the stock below its intrinsic value. So next, I'll move on to the CVP analysis.
Okay, cost volume profit analysis is a cost volume profit method of cost accounting that examine the influence of various level of expenses and volume on operating profit. It's a type of analysis whether product manufacturing is economically justified. The accuracy of CVP is based on assumption it makes, such as constant sale price and fixed and variable cost per unit. Next. This is a graph showing a break-even analysis, the correlation between revenue and unit sold, and also where is the break-even point, whether it is profitable or non-profitable. Next, break-even analysis. So it's a number of unit or amount revenue that must be earned to pay product manufacturing costs. If the break-even point is the moment at which a product total revenue equal its total expenses. Next, based on the table above, for the year 2020, the break-even point for Huatai company is about 33 million. This means that for the year 2023, 33 million is required to cover the product manufacturing cost, meaning not making any profit or not making any losses. So any value above 33 million is considered a profit, and any value below it is a loss. Next, margin of safety. Managers use margin of safety to figure out how much sale can drop before the company loses money. So the margin of safety shows the risk of the company to suffer losses if the sales decrease. So based on the table above for the year 2020, The margin of safety for Huatai company in RM is about 42 million. And for the accounting period of 2020, the sale need to decrease by 22 million before the company suffer losses. And for the year 2020, for the margin of safety in percentage is 55.8%. This means that the company can afford to have reduced in sale up to 55.8% of its revenue before experiencing any significant losses. Next. Operating leverage is a cost accounting metric that determines how much a company or a project may raise profitability by boosting revenue. A low operating leverage company may have high variable costs that are directly proportional to revenue, but they have lower monthly fixed costs to cover. A company with more fixed costs relative to its variable costs is considered to have a higher operating leverage. Next. So, according to the table above, the operating leverage for Huatai company for year 2020 is 20.5%. It means that in the year 20, having a high operating leverage tend to be beneficial on its profit margin and free cash flow profile. However, if the revenue declines, higher operating leverage can up being detrimental to the margin of the company because the company is restricted in its ability to implement potential cost-cutting measures. Next. So in conclusion, currently the company is heading towards recovery from a non-profitable state in 2018 and 2019. The company needs to strategize and came up with some strategic solution to improve its financial capacity. One way to overcome this is by consulting a professional to give a valuable view regarding the financial issues and offer valuable insight to analyze the internal and external situation in the company to fully understand its strength, weakness, opportunities, and threat. Quoting a famous Seth Godin, there is no shortage of becomable ideas, but missing is the will to execute them. With that, thank you.